Hi, I'm John Nersessian, Head of Advisor Education at PIMCO. Welcome to our conversation around behavioral guidance during market volatility. The past few months have exposed our clients to significant volatility, both emotionally and in their financial portfolios as well. We're going to examine some of the very best practices that top financial advisors are utilizing to keep their clients on track and to ensure the long-term returns that they seek. Let's take a look at bull market and bear market experiences. It's my belief that more money is lost in anticipation of bear markets than in the actual bear markets themselves. Let's examine the S&P 500 returns going all the way back to 1950. And while these periods of market drawdown can be upsetting, it is the returns available during the longer duration bull market experiences that enable our clients to achieve the financial results they seek in order to realize their long-term financial goals. Geopolitical shocks like the one we're enduring currently can have a significant emotional impact on our clients and their approach to investing. Take a look at some of the more recent events: the bombing of Syria, the Iraqi war, the 9/11 attacks. And while the drawdowns experienced during each of those particular events may have been significant, take a look at the forward returns 1 month, 3 months, and 12 months later, where significant returns were available to investors who were able to endure those periods of short-term market decline. The same results can be found by looking at the fixed income market as represented by the AG, the bombing of Syria, the Iraqi war, and the 9/11 attacks. Once again, all produced significant drawdown during the events, but a 1 month, 3 month, and 12-month forward-looking view provided significant opportunities for investors to earn the returns they seek. Now, when we talk about behavioral guidance, we think it's an important role that the financial advisor plays in helping their clients control their emotions and the way in which they process information in order to draw logical and productive financial conclusions. This concept of behavioral finance has a significant impact on investor returns. And many advisors refer to their alpha, their value in that client relationship, by providing guidance, particularly during periods of extreme market volatility. Take a look at the Dalbar results that examined the market return from 2000 to 2020. And while the market provided ample opportunity for investors to earn decent returns, the average investor often underperforms. It's not due to a lack of intelligence. It's not due to a lack of effort. It's the impact of emotions on financial decisions, which often lead investors astray. Here are some of the common biases that cause these divergent results. We've identified both cognitive biases, those that are affected by the way in which we process information, and then emotional biases, those that are governed by the way that we feel and our reactions to market volatility. One common bias that often has a significant impact on investor results is recency bias. You know it well. It's the idea that investors feel more comfortable adding money to risk assets after periods of strong market returns, and they use decline in risk assets as an excuse or rationalization to reduce their exposure. This tail-wagging methodology is often what produces that significant gap between market returns and investor returns. We've identified a number of best practices that advisors can use to help keep their clients on track. Number one, to identify the appropriate behavioral risk for each of their clients individually. Second, to develop long-term investment policy statements, guardrails, if you will, to help make future financial decisions. We encourage advisors to utilize automated investment programs, including dollar cost averaging, to help reduce the temptation to time markets. We also encourage diversification, not just for additional return opportunities, but to smooth out market results, which can help to keep our clients emotionally on track. Asset bucketing is the concept of immunizing various financial objectives to help our clients rest assured that their objectives will be satisfied. Of course, we encourage clients to take a long-term perspective. And then finally, the concept of rebalancing, which forces the investor to do what is financially productive but emotionally uncomfortable. Let's go further in this conversation about risk. It's a four-letter word that means different things to different clients. Some clients define risk as market volatility, others as a loss of capital. Others define risk as the probability or failure to achieve their unique financial goals. We think probabilities are less important than the consequences suffered from risk and the exposure that our clients have to them. Here are some questions that can help us further identify our clients' individual feelings towards risk. How has recent market volatility affected you? Has it changed or altered any of your personal goals? How do you specifically define risk? How do you measure it? And how do you try, or what steps do you take to try to manage it? If you received new funds today, how would you allocate that capital, given the recent market volatility that we've all experienced? What would be more upsetting to you? Holding securities that continue to exhibit volatility, or selling securities and missing out on the eventual rebound? When it comes to behavioral risk, we think there are a number of critical steps in managing these risks appropriately for our clients. The first of which is to identify whether or not that risk exposes us to an identifiable hazard, and then determining the consequences of that risk and the probabilities of occurrence. We've identified a number of financial risks that your clients may be exposed to for further clarification. Finally, when it comes to communicating with our clients during periods of significant volatility, it's critical that we allow our clients to embrace the appropriate guidance that we're capable of delivering. One of the phrases that we often hear is stay the course, which is well intended. Stay the course, I suspect, is intended to suggest that clients should stick with their long-term viable financial plans. They shouldn't engage in market timing or make any drastic changes to their current investment portfolios. Unfortunately, clients may misinterpret the advice. What they may be assuming is that my financial advisor doesn't understand the emotional pain that I'm currently enduring. They're not empathetic. My financial advisor isn't concerned about me or my current financial situation. Or maybe my financial advisor doesn't have the time or the expertise to provide me with the guidance that I seek. We think there's a better approach. We think clients need to understand that we hear them and that we recognize the financial and the emotional pain that they may be enduring during these periods of volatility. We encourage you to continue to consult with your clients in a productive manner that considers their unique situation and their specific financial objectives. We've done a lot of work on the concept of behavioral finance and have assembled a number of resources that may be helpful to you in your best practice endeavors. We encourage you to visit the PIMCO website or to contact your PIMCO account manager to learn more.